Hello, and welcome to the Tomorrow Money Show, the podcast where we talk about money, technology, and the future of finance in Zimbabwe and across Africa. Today's episode is going to be a controversial one, but also an important one. We are talking about the 15% digital services withholding tax that was recently introduced in Zimbabwe and is now in force since 1 January 2026. I will talk about why it exists, how it works in practice, and most importantly, what are the ways to legally avoid paying it by using crypto. Before I begin, a very important disclaimer. I am not a lawyer, I am not a tax advisor, and nothing in this episode should be taken as legal or tax advice. This episode is strictly for educational and informational purposes only. I am explaining how the law is written and how people are interpreting it in practice, or how it should be interpreted based on the text. What you choose to do with this information is your own responsibility. I take no responsibility or liability for any actions taken by listeners based on this content. With that out of the way, let me get into it. What is the Digital Services Withholding Tax? The Digital Services Withholding Tax, or DSWT, is a 15% tax applied to payments made by Zimbabweans for digital services provided by companies residing outside of Zimbabwe. Think of services like Netflix, Spotify, Google services, Facebook and Instagram ads, cloud services, software subscriptions, streaming platforms, and so on. The government's logic is simple. Zimbabweans are spending money on foreign digital services, and the state wants a share of that revenue, which is to be honest, understandable and reasonable. When you buy a 2 kg of sugar, you pay VAT, but when you pay for YouTube Premium, you should pay a fee like VAT also. I'm not saying I like the text. I'm just saying the intention. I see the intention, but as you might know, the road to hell is paved with good intentions. The way this text was written and is supposed to be implemented is where things start to get interesting. How is this tax collected? This is key. The tax is not collected from you directly. Instead, the law says that financial intermediaries, mainly banks and card processors, must withhold 15% from your payment, remit it to Zimbra, and then issue you with a withholding certificate. In simple terms, if you pay for Netflix using your Visa or MasterCard, the banks takes 15% and send it to the tax authority. You don't have to file or report anything. The responsibility is entirely on the intermediary. This design choice is extremely important because the tax only applies where there is an intermediary. When there is no intermediary involved, then there won't be withholding tax. This is where crypto enters the conversation. Cryptocurrencies like Bitcoin and stable coins such as USDT allow you to pay directly, settle peer to peer, or move value without a bank acting as an intermediary. When you use crypto, there is no bank processing the payment. Hence, no institution is legally required to withhold anything. And the law as written does not place the obligation on you, the payer, to report or remit this tax yourself. This is not my opinion. This is what the text of the law says. So, from a purely legal structural perspective, the tax simply does not attach when the payment rail is crypto. Is this legal? This is where people get confused. Avoiding a tax is not the same as evading a tax. Tax evasion is illegal. Tax avoidance, when done within the boundaries of the law, is legal. So if the law says only intermediaries must withhold, and you choose a method that does not have an intermediary, you're not breaking the law. I think you are just exploiting a design flaw in the tax code. Again, this is not advice. This is just an educational explanation. Crypto is actually cheaper to pay with in practice compared to Visa or Mastercard. If you pay using a bank card now, there is this 15% withholding plus bank charges that can be 5% to 20% depending with your bank. This can end up costing you 25% or 35% per transaction. Compare that to crypto where you just buy USDT or Bitcoin from a local agent that can charge you 5% for the Bitcoin, but there won't be any withholding tax. It's even better if you already have the Bitcoins in your wallet. To be practical though, not every service accepts crypto directly, but many already do, especially in the digital first world. VPN services, web hosting, e-commerce platforms, and so on. In many cases, people also use what are called crypto debit cards issued offshore. The ecosystem already exists. This issue of the digital services withholding tax exposes a deeper truth, which is that governments are still writing tax laws for a world where banks are unavoidable and payments are centralized. Crypto breaks that assumption. I just have to say, however, crypto is not strictly legal tender in Zimbabwe. And also, exchange control and money laundering laws still exist. So be careful of those laws because you might not be prosecuted for tax law, but might be prosecuted for money laundering if that is the case. This episode is not encouraging anyone to break the law, but it is highlighting that when laws are poorly designed, people will route around them, especially when technology gives them the option. If you found this episode useful, share it. If you disagree, that's fine. These kinds of conversations is how we move forward. This has been the Tomorrow Money Show. My name is Mnyaradzi Togarepi. Thank you for listening.